Good morning and welcome to another episode of Money Matters. My name is Nev and we're broadcasting live, of course, from Rhode Island every morning at 7 a.m. on onedealaway.com. And I want to welcome you to another episode where we have all kinds of cool things to talk about, from potential security risks from your favorite phone app all the way to what can we expect on the second stimulus check and the timeline and kind of how does it all work. And then we're going to go in and talk about sort of what's going on with the coins, with the markets, what are the risks, what are the benefits, and where do we really stand, and what can we expect that the second part of the year is going to happen, because it is July 1st of 2020. We have officially begun the second half of 2020, and we'll see if the second half will be any more exciting or less exciting, for that matter, depending how you like to have your excitement in the morning, than it was in the first year. Personally, I am hoping for a bit less excitement when it comes to the health pandemics, economic collapses, but it doesn't look like that I will get my wish. Although, we'll see. Let's do this. And good morning. I hope you're having a fabulous Wednesday. I can't believe that it's Wednesday, that it's July 1. I mean, 4th of July is right around the corner, right? It is this weekend. And right after that, I mean, it's back to school, whatever that may look like, given the current pandemic. And once we hit the school, it's Halloween, Thanksgiving, and it's year over. So not a whole lot of time left for 2020, but of course we do still have 6 months. So I semi-jokingly say there's not much happening after this, which is completely untrue, and we do still have a solid 6 months to deal with all kinds of interesting stuff and perspectives, right? So yesterday I briefly talked about sort of the second stimulus check and the timeline, and have shared stuff with you that, we may not necessarily get all of that stuff happening. And today I just really briefly want to share with you this article that talks about the second stimulus check timeline and all the things that you might want to know. So basically, it's called the HEROES Act, and it passed the House, but it's waiting waiting a vote in Senate. The whole WV thing in a session, I have a hard time moving my mouth that way. We may not have had any official until middle or end of July. So there is a potential that things are going to expire well before this thing is reached, which is why I keep saying you definitely want to have some cash saved up if you're depending on the government to help you out with these pieces. The second stimulus check proposals are based on CARES Act stimulus check eligibility criteria, and it lists all of that stuff in, but I think you already know that. And the difference is that they are talking about some potential expansions, putting in the more people or not. So there's a few different proposals that are being talked about. They are discussing them here, so we're going to cover them very briefly here, and then we're going to move on to other things because we have a lot to cover today. It includes a $1,200 stimulus check per adult and $1,200 per qualifying dependent, up to 3 dependents per family, for a maximum of $6,000 per family. HEROES Act provides a stimulus check for all dependents regardless of age, which is different than CARES Act. Odds of passing, not great. All right, thanks for getting us excited for nothing. Oh, here we go. Second proposal, 2,000 monthly stimulus check proposal. That one sounds nice, doesn't it? Other notable stimulus check proposals, which call for a monthly 2,000 stimulus check for the duration of the COVID-19 crisis. And it's basically saying that it's going to provide 2,000 monthly stimulus check for up to 1 year. The second one is saying, we'll do that for at least 12 months and then additional 1,000 for the second 12 months. And they are basically, the Forbes has estimated that 2,000 monthly stimulus check could cost anywhere between $3 and $10 trillion. Odds of passing next to zero. Thank you for getting us excited for something that is never going to happen. Then we have other pieces that are coming in. One of them proposed is Rent and Mortgage Cancellation Act, which would cancel rent and mortgage payments for an individual primary residence for up to 1 year. Second one was a payroll tax rebate that covers 80% of payroll expenses. And the third one, which I told you about, is like a coupon from the government, which is offer a $4,000 tax credit per adult to take a vacation at least 50 miles away from home. Odds of passing, the rent and mortgage cancellation, as well as the TRIP Act, have very little chance of being passed. However, there are several discussions about the payroll tax waivers. And while there is a support for second stimulus check, it is not universal. A lot of the conversation, as they're sharing here in the article, as well as the other articles that I was able to find, a lot of them are focusing on employment and the business related reliefs rather than individuals. So as you know, we do have a president that tends to favor businesses, and that's why I think we could potentially see something that might help businesses, and hopefully it's going to be something that potentially could help the employees. However, this whole trickle down economics, I don't know how you feel about it, but personally I don't see it running all that amazing, and I have a hard time, sort of buying it and dealing with it because it's not trickling. It's not trickling fast enough, and I have a hard time, being on the end that receives, pennies, while the other ones are receiving gold coins and in abundance. Speaking of pennies, I think we need to talk about this incredibly important article and news story of what is going on with pennies. I know you're thinking I'm crazy and you're sitting there like, money matters and you're going to talk about pennies, Nev? Yes, I'm going to talk about pennies because it is important. Check it out. You ain't going to believe your eyes. Mayor stops accepting cash as nationwide coin shortage erupts. As a result of the shortage, at least one major supermarket chain has removed the ability to pay in cash. Mayor Inc., a supermarket chain based in Midwest, announced last Friday that self-scan checkout machines at 250 supercenters would only accept credit or debit cards, SNAP and EBT cards, and gift cards. Now, I'm going to switch to a different article that is coming in that was posted about a week ago, maybe a little bit less, that says, having closed the U.S. Mint and halted production after a surge in demand for gold and silver coins and warned of danger of using bills, Fed Chair Powell quietly admitted to lawmakers this week that the Fed will be rationing coins as the circulation of coins across the U.S. economy ground to a halt due to pandemic. Shortage was due to mass business closures that prevented people from spending their coins. This is very interesting and very important piece, and we need to talk about it. So, first off, there's a shortage of like pennies and dimes and quarters and basically anything coin related. There is a big shortage, okay? And so now businesses are getting squeezed and saying, I can't accept cash because I can't pay you back. Like I can't give you change. So we are out of change, a country that is so hungry for a change, and we are out officially. Now, the part that is kind of interesting is the fact that we are out of coins, and it sounds like they're going to be, and we'll cover it in a moment as well, but it sounds like they're going to be sort of doling out change, appropriating it to the businesses throughout the nation. But the part that is also interesting and should not be forgotten is this line right here, okay? Closed the U.S. Mint and halted production after surge in gold and silver coins, okay? Yeah. So if you think that we might experience an even bigger squeeze, an even bigger shortage of gold and silver, you probably are right. What does that tell me? Well, that tells me that the physical gold and silver prices will more likely than not go up. Now, the spot price is different, and I know that physical follows the spot price, but you also pay a premium when it comes to physical gold and silver, physical precious metals. So if the spot price is 1775, for example, for an ounce of gold, you can expect that you might have to pay $100 extra or $200 extra, or if it's really tight supply and demand kind of game starts goes afoot, um, it wouldn't shock me if the spot market is 1775, but physical is like 2775. Nothing would shock me these days because the market ultimately sets the price, regardless of what happens with manipulation, especially when things catch up and in physical. Back to our coin story. Now, here we go. There are the signs, and they're like, yeah, national coin shortage. And you can see it right here. They're saying, nope, not happening. Okay. So here is that whole piece that the Fed has been rationing coins as the circulation of coins across the U.S. economy ground to halt due to pandemic. And you can see that folks have been searching. Google Analytics is showing that more and more people are searching about coin shortage, and you can see where it's predominantly happening. So you can see that it's predominantly happening inside the United States, so the Midwest. However, we do have Maine, and that is right here on the East Coast. The issue isn't limited to just Mayor stores, but it is widespread. Check it out, y'all. Austin, Texas. Where is this? This is KGBT. I don't know where that is coming from. My apologies for that. You can see, I mean, it's just kind of happening everywhere that we are seeing this stuff. And social media users report the shortage is happening in many big box retailers. Yeah. They are basically all reporting it, saying, hey, who else is seeing this stuff? So if you are seeing it, you're not alone, because there are other people that are also seeing this as well. And, this is kind of where we are right now. We are short, and no, see, even Lowe's is saying, like, we need you to use either correct change or use your card. Thanks for playing along. Now, the question that came out of this article is this a sly move to ban cash transaction in favor of credit cards under the guise of coronavirus-related issue? That is the same questions that I have been having for a little while, and we've been seeing that they have been saying that, hey, cash can pass on the virus. Now we have coin shortage. And we're hearing from many places, many countries, that the digital money is coming. Digital wallets are coming. Even for the second stimulus, there's a lot of conversation about this money being fully digital and showing up to us that way. Now, I don't know if the government is fully ready to go all digital, although most of our money is digital anyways, if you really think about it. I don't know if it's going to live on a blockchain per se, but, I think the world is going to go crypto. I've been talking about it for forever. I don't know what exactly it's going to look like, but, the cash as you know it, I don't think it's going to be something that we keep in museums and to showcase to our kids and grandkids, because I don't think that it is here to stay. And that's kind of one of the things that I am, I don't want to say bullish on, but I do think that that is kind of where the future is. And this is the reason why I'm so wanting to talk about the cryptocurrencies and wanting people to start going in and learning about them and how they all work. Because once these things roll out, if you're left behind, you are sort of the lowest man on a totem pole. I don't even know if that is saying still. Is it? Is it okay to say? I don't even know what it means. Maybe I should stop saying it and learn more about it. Anyways, let's change topics. I told you at the beginning of the show, what if you had an app on your phone that maybe wasn't as safe as you thought it was? And if you are thinking I'm talking about TikTok, you are right. Here we go. Yet another article about TikTok and sort of what's happening beneath its fun exterior and what's going on sort of underneath it on the tech side. And they're saying for 3 years, it's been out there for about 3 years. It was launched. It has about 2 billion downloads, one of the most popular apps at the moment. And if you don't know what TikTok is, it's basically a user shared content where you can go out there. Typically it started with the sort of like sing and dance, pranks, that kind of stuff. But more and more entrepreneurs and business owners are jumping in it in the hope to sort of take over and build their audience. Now, there's some pretty good cases when it comes to TikTok of how you're able to do that stuff. However, there's also a lot of warnings about TikTok and safety issues for its users. The U.S. Armed Forces have forbidden personnel from using it, as described as a threat to cybersecurity. Israeli cybersecurity company Check Point has investigated and concludes it has backdoors and major vulnerabilities as well as overall security issues. The U.S. government is also investigating, and meanwhile, Reddit CEO and co-founder Steve Huffman describes it as a fundamentally parasitic app that is always listening and warns against installing it. Apple claims it has caught TikTok using a clipboard capture mechanism to spy on millions of users. Now, what they're saying is that, in short, it is not hard to find evidence of the problematic nature of TikTok, and yet the app is still thriving. And they're saying, like, I don't know. We've talked about it for a little while. We think that TikTok, the way that it's built, is irresponsible. And you should be very, very careful that the philosophy, because this is a Chinese company, they're saying that the philosophy behind this company is also a philosophy that is being shared within China, and that is to spy on its citizens, to know everything that they're doing, everything they like, everyone who they talk to, and really build this vast network of knowing every single thing about you more than you even thought is possible. It appears that technology-wise, that there's ability now to analyze folks based off of the meme that you post out there or the dance that you end up doing. And, people are talking about a danger for kids, danger for adults, the fact that it's tracking you in a whole host of things. Beneath the seeming innocent exterior, TikTok is a public danger. If you know anything about cybersecurity, if you know nothing about cybersecurity, let me correct myself, trust the number of analysts who have been saying it for a while. And yeah, so there's many people out there that are warning about TikTok and about you using it. So if you do have it, if you do love it, I completely understand. Personally, I have downloaded it for a little while and I jumped kind of in it and on it. And then I decided, there's too much risk. There's too many people that talk about it being risky, that I decided to basically delete it from my phone. So I no longer have TikTok. I tried it. I understand the coolness of it, but it just wasn't worth it for me. The tracking and everything else. I do value my privacy. Perhaps I'm on a crazy conservative tinfoil hat kind of guy, and I'm okay with that. All right, so now going back to the markets, the Fed, and what's going on with the money, we're going to go and talk about how Fed is driving savers to risky investments. And then we're going to talk about some larger risks when it comes to Tesla, as well as what is going on with the Wall Street and what are some of the signs of potential danger that could be looming ahead. Now, one of the things before we go into this stuff, sorry, y'all. My air entered my eye, I think. One of the things that is interesting, Fed Powell a little while ago has gone onto the record to say, us printing this stuff, we are not creating a greater divide in income and wealth inequality. And I personally disagree. I don't know how you feel about it. Let me know in the chat. Let me know in the comments. And by the way, if you're watching this live, welcome, welcome, welcome officially on this particular line. And if you're watching on YouTube, welcome as well. Do me a huge favor. do hit the like button, do hit the subscribe and the bell so you get notified every day that the show posts as a replay on YouTube. Or better yet, join me live tomorrow morning, every morning at 7 a.m. New York time, as I like to say it. But one of the things that I disagree with them is because when they print the money, vast majority goes to the business owners, to the wealthiest of individuals, to the CEOs, and really that Cantillon effect that you likely heard from other places and other people that talk about, that basically says that those that are closest to the money source tend to receive most of it. And then the further out you go, the less you get, which is that whole concept of trickle down that I talked about, that it's sort of like the regular human mortals, mere mortals, as I like to say and call myself often, it's sort of like a being the grass in a dense forest. Eventually, you do get a little bit of water, just enough to survive, but not a whole lot, so you can keep on growing and thriving. Because all of the rain, all of the water hits the tallest of the trees, and then it kind of comes down to a little bit lower, a little bit lower, a little bit lower. By the time it hits the ground and the little lowly grass, there's not a whole lot of drops left because the trees have soaked it up. That is kind of what happens with Cantillon effect and the money. And this article is incredibly important because it does talk about the reason of why Fed is driving savers into risk investments. Way back when you could put a little bit of money into savings, a CD, that kind of stuff, and be able to get a nice, healthy return. Nowadays, you do that, you don't get much of a return, if any. And if and when the prices kind of rise through, and which is expressed through the inflation component, you're actually losing your money. So let's talk about it. Let's look at it. Let's learn, because I think it is important to understand. The stock market has risen sharply in the past 3 months, in large because of the Fed, right? They've been printing money. Where does it go? Well, it goes into the stock market. Everybody knows that. And they themselves have been buying things, right? They've been buying stocks. They've been buying ETFs. They've been buying bonds. I mean, they are buying the freaking market. Okay? Ultra low rates have made it much cheaper to finance our country's 13-digit budget deficit, right? It's the trillions and millions. But the problem is that it's leaving millions of individual investors being forced into the stock market to get any meaningful income from their savings, because they can no longer count on traditional havens like savings account, certificates of deposit, treasury securities, or money market mutual funds. The dividend yield on S&P 500 or total stock market index fund is about 1.8%, almost triple the yield on a 10-year treasury note and considerably higher than the 1.37% yield on a 30-year treasury bond. Stop and pause, as I like to say. We got to talk about this, y'all. We got to have serious talk about this. 1.8%. Sounds quite lovely because of everything is so low. However, there's a high risk that once this deflationary period kind of blows over, and it will at some point, I just don't know when, that we're going to go back into the higher inflationary period, and we're also experiencing some sort of deflation on some things and inflation on other things. 1.8% yield is not a lot of money, not a lot by a long shot. It's nothing. We used to laugh at CDs or saving accounts offering 2% or 2.5%. This is less than that. Now, I know what you're thinking. You're saying, well, where do I put my money, Nev? Because this is silly. Number one, okay, we're going to talk about it. I don't give recommendations of what you should and shouldn't do. I give sort of a conversation of what I do and how I think about it and how I advise my kiddos kind of to think through this stuff, okay? So I'm going to share that with you, and I hope you're okay with that. Number one thing that you want to do is keep your education going. You got to keep on learning about different investment vehicles, how they operate, how the economy works, what's going on, and probably the easiest and best ways is just to stay tuned with Money Matters Live. It's free. It comes every morning, and we talk about all kinds of stuff. The second piece that I also recommend is get yourself into some sort of online course, whether it's with One Deal Away, which is the company that I oversee and run, whether it's with another company that you want to go in that is going to help you with investing and savings and different vehicles and how it all works. But get somebody who can teach you how to do these things, okay? That's very, very important. Those are going to be the two things that really wrap up into one, and that is the education that is being very, very important. And if you're interested with One Deal Away company, of course, we have plenty of different products. Probably my favorite one would be the Academy, just because I think it's the most affordable way to go. It provides for monthly payments. You get access to everything, and you pay as you go. So no long-term commitment, nothing crazy that you need to worry about of saying, oh my gosh, I bought something, now I have to stick with it. It's a 2-year contract. None of that stuff. So that's the reason why I'm very bullish on the Academy from One Deal Away, because we do talk about all these things and teach you how to do that. The second thing that you want to do, or maybe the third thing, since education kind of has two components, is to start considering other investment vehicles. There's plenty of spots and spaces and places in real estate that you can jump in, get things at a deep discount, and instead of a mere 1.8%, you could be looking at 18% or 180% or 1,800%. So there are ways to actually boost that stuff, but it's outside of the market. It's outside of what the average Joe knows, and that is go on Robinhood, click a button, hope and pray, cross your fingers that it goes your way. The third component, or the fourth component now, is cryptocurrencies. I think cryptocurrencies offer some amazing returns, but you got to understand how it all works, how to invest it. So you want to definitely start learning about it and then go in and invest in it that it makes sense. Again, not a financial advice. You got to do your own research to understand of what you should or shouldn't do, what you can or cannot do. These are just the ways that I like to process this stuff and talk about it and things that I am doing in my life. I am very bullish on crypto. I am very bullish on real estate, and I am very bullish on precious metals, especially in the physical form. The stock market, I don't know. It's too much risk for 1.8% return. That's just my personal humble opinion. If I'm going to take a risk, I want to get a reward. So I look at asset classes where the risk is low, returns are high. Stock market right now, in my humble opinion, risk is low, returns are high, and that just doesn't bode well for me. But let's continue. Dividend yield comes with a serious risk, the 1.8% high dividend yield. Okay. And one of the risks is that you're getting into the market, which has been the most expensive market ever. Even though much of the economic stimulus that Congress put into the economy with the CARES Act and other legislation seems about to run out, there's no sign of new round coming anytime soon. As a result, I think we're also about to see large workforce reduction by states and cities. And of course, when people are losing jobs, you don't get additional income. Fed might be stopping, and we already know that they are pausing and slowing down in purchase. We've covered that here on this show. There's only one direction that market can go when all of those forces hit, and all of them are set to hit at the end of this month. So we have less than 30 days, y'all. We have about 3.5 weeks before we see some of that stuff. So we are starting to enter a high risk period. That's just my humble opinion and my thoughts. You do as you do. But I just am putting out there my thoughts in case you're interested. And if you got serious money, by your standards in the U.S. stock market, you better have both financial and psychological staying power, because they're saying it's going to be a very sort of volatile and potentially risky ride. And they're saying you better not bet on the Fed being able to bail you out, because it's already been done more than anybody ever thought so. And so that's one of the news that is coming that I wanted to share with you, that I think it's very, very important. The second piece that kind of goes along with this particular article is Wall Street faces dangers Danger signs after best quarter since 1998. 22 years. 22 years. And they're saying, hey, all of that amazing stuff. This was the best ever. And meanwhile, we're in pandemic. Does that make sense to you? Because it doesn't make sense to me. But hey, crazier things have happened, and clearly they will continue to happen. A stock a stock rebound market by Wall Street's strongest quarter in more than 2 decades has slowed in recent weeks. We talked about it yesterday, y'all. We talked about it yesterday. S&P 500 up 20% in the quarter ended on Tuesday and just 8% below its February record high. Even after 2 days of strong gains this week, S&P 500 is down 4% from early June. Okay, underscoring investors' recent concern at U.S. coronavirus cases trend higher. Okay, the S&P 500's strongest quarterly performance since the fourth quarter of 1998 during the dot-com boom was driven by gains in April and May, followed by an overall flat June. And yeah, you can see kind of what's going on. So here is the average new cases. You can see that we've kind of rolled back down. If this was a stock right up here, I'd be buying. Let me tell you that. But it's not. And, I would never want to bet on people getting ill. But I'm just saying, if this wasn't the new cases and stuff, but it was sort of like a stock of a company, this is the part where I'd be buying. Here is the S&P 500. It doesn't look that sexy to me. I don't know. Call me crazy. Investors' enthusiasm has been driven in part by recent economic data that were better than expected. And right over here, it's talking about the growing potential economic impact. So here is the April data. Here is the June data. It's very tiny, but it's just talking about, sort of like where the cases are and kind of how things have shifted and stuff. So a spike in virus infection in southern and western states last week spooked investors. Much of Wall Street gains in recent months has been driven by the trillions of dollars in stimulus from Congress and the Federal Reserve, and by investors' confidence that the Fed is prepared to take additional measures to support the economy and financial markets. The S&P 500 forward price earning ratio is closely followed valuation metric now stands at 22, its highest level since the dot-com boom. Folks, they've mentioned dot-com boom here twice. And I don't know about you, but I'm thinking they're trying to tell you something. They're trying to tell you something without saying anything. Strong second quarter. The driving much of Wall Street's strong second quarter were shares of companies that benefited from people staying home. Think of like Amazon, Zoom, Microsoft, right? Like we've talked about it earlier. This is just sort of confirming our conversation and driving it even further. And you can see where the growth has been happening. So you can see consumer discretionary is up 30%, information technology 27%, energy 26%, materials 24%. The utilities are like down here, consumer staples, financials, real estate is really low. So the yields on treasuries stumbling in recent months due to uncertainty about the pandemic, dividends stood out as an additional reason to buy stocks. So basically the treasuries are telling us this is not going to go and end well, but it's also doing something that we just talked about, which is pushing everybody from historically safer asset classes to a much higher level risk asset classes for not a whole lot of difference in return. And as we discussed, if I'm going to take more risk, I want a heck of a more return. It's just the way that I like to invest and the way that I like to teach my students how to invest. Better yet, I actually like to go into super low risk investment that still give me 10x at least of what they were talking about that the average S&P is. I'm just not bullish on the markets, as you can see, but that's okay. So here we go. We're seeing this stuff. You can see the S&P dividend yield, which is the yellow, and you can see the blue, which is the 10-year treasury yield. And you can see, look at this discrepancy, y'all. Look at that. I mean, if that's not crocodile jaws, we talked about it previously. I don't know what it is. And you can see the spread of the S&P dividend yield versus 10-year Treasury. And you can see that it's higher than it's ever been. The outlook for dividends has worsened. After S&P 500 dividend hit a record high of 127 billion in the first quarter, according to S&P Dow Jones indices, several companies have suspended or cut their dividends. So now folks jump into stuff thinking they're going to have dividends, and those got cut. Then the Fed capped back dividends and barred bank share repurchases until at least the fourth quarter. So now you have an interesting dynamic that is happening. You're not getting anything in your savings or CDs. You're not getting anything in your treasuries, okay? But you're taking a bit more risk. And then now you're jumping into the market thinking you were going to get some dividends. But guess what? When it comes to the stock market, you don't control anything. They do. They get to decide whether you get dividends or not. This is yet another reason why I'm not so bullish on the paper assets and why I prefer to go into things like real estate and crypto, especially real estate, where I get to control my assets. The key component within business, within investing, is control. You might want to write it down somewhere, okay? Because that is probably the most important thing. And to finish off, we have something that is very interesting that I think you may or may not like. I don't know. Let me know in the chat. Let me know in the comments. And as soon as we finish this particular article, we are going to basically jump into the chat and chat away, answering questions and dealing, hanging out basically. So, Gordon Johnson warns accounting impropriety at Tesla similar to accounting at Wirecard. Pause. Let's talk about it. Now, Wirecard, what you may or may not know, if you've been watching and paying attention to our show, then you definitely know this. But in case you haven't, you may not know this quite yet. Wirecard is a German company that is basically a credit card service provider. They have been caught with an accounting fraud that has caused all kinds of issues, including for the favorite DAX stock to basically like tumble to the lowest of the low. But hey, maybe Robinhood will pick it up and the retail investors here in the United States will just buy it on up. But there goes that. All right, maybe I should stop with the sarcasm. Okay. No, but so that's kind of what it is. And so they're saying that, hey, Tesla is doing something very similar to what Wirecard did, which caused problems for them. Right around the same time that Tesla was leaking to Electrek that the company could break even in second quarter despite the pandemic, analyst Gordon Johnson of GLJ Research was putting his clients on notice about continued deception and accounting impropriety that is similar to Wirecard. This is huge, y'all. Johnson estimates on Monday that Tesla has recognized just $1,427 per car in warranty reserves versus the $3,308 per car that it should. This has led to a gross profit overstatement of $148.93 million. So basically what they're saying is, when you have a car, you have to have some sort of warranty reserves in case something happens. And they're saying, well, it should be over 3,000, but they just have 1,500. So they have less than 50% that they're accounting for than they should, which is what's boosting their sort of revenues and returns and income and that stuff. Johnson then posted several examples of the company accounting for warranty costs as goodwill, thus artificially boosting its gross margin and net income. Johnson also noted last week that Tesla's end-of-quarter push didn't seem to be going well, which contradicts what has apparently been leaked to Electrek. So you can see the sort of the deliveries for Florida, Texas, and they're saying that the end-of-quarter push is at the weakest it has been since they ran out of cars in fourth quarter of 2019. However, this time they do have a record level of inventory. And here he is saying that there's a record level of inventory, unlike in previous quarters where they couldn't do it because they didn't have inventory to do it. And basically he's saying, for all of those not familiar with accounting who still want to get the gist, it's all on Twitter. And if you want to read this article in detail, it is, I will drop it in the chat, so that way you'll get the link and I will put that in the chat right away. So there you go. Warning to all of the Tesla users and folks who are using this stuff. Please be careful out there. As you can see, there's all kinds of stuff that is going on, and there's all kinds of risks that are popping up left, right, and sideways. And it's important for us to pay attention to all of those things. One of the best ways, in my humble opinion, is to stay tuned. Come back every day to Money Matters. If you can make it live, do it on onedealaway.com, where you can ask your questions live, or you can just simply watch it on YouTube. All of the replays go on YouTube and some other channels as well. But make sure you do subscribe, hit the bell button, and if you could do me a favor, do hit that like button so that we can get more people into the channel and help more people out, because things are shifting rapidly, and I want to make sure that we all can keep track of it. Until tomorrow, stay forever money blessed, and do remember, you are only one deal away.